investors are always interested in income, and in the equity space, that seems to have been one of the kind of rare, resilient parts of the market, from things like commodities to perhaps some of your companies that are a bit more kind of slow and steady, not very glamorous, but they do pay a kind of a rising dividend. And Christian, I wanted to kind of turn to you first on this front, because I suppose what interests me is that that divide that I've just kind of set out. Do people kind of go for those interesting higher yields, the more cyclical plays, or is it better to go for those kind of slow and steady defensive companies? You to an extent look at yield. I mean, where have you been finding kind of interesting opportunities?
Well, as you know, Brunner is kind of seen as an all-weather fund. So we take a dual approach on it. We, of course, go for dividends. We like dividends and the income stream. And Brunner has 50-year history of not cutting the payout. We have 50-year history of actually rising the payout. But at the same time, investors are also looking for a capital protection and a kind of a rise in the capital they have. And so we also invest in companies that have the ability to grow their intrinsic value and at the same time grow the dividend. So it's a dual approach here. And as such, not just going for the highest dividend yielding companies, because often those are the ones that do not have any growth opportunities anymore, because they kind of acknowledge that and pay out all the cash flows to the shareholder. So our approach is rather to go for those that are able to steadily increase their dividend and both boost that income payment as well as generate some capital growth. Now, how do we do that? Of course, I mentioned earlier, we look for quality companies, those that have a strong moat around them, that have a bit of structural growth and strong cash flows. And very importantly, in these days, I think it was mentioned earlier, we're looking at the balance sheet of our companies. I think in a period where interest rates are rising, that is a very important factor, that because I always see it, and sorry, Ben, kind of the bond side being the dark side of the power for me as an equity investor, because as an equity investor, I receive residual income. So all the money that's left over after the bond holders are paid and the bank is paid. So I need to make sure that our companies in times of rising rates are not overly levered. And much to the point that Chris earlier made, I think it's very important. The period of the last 10 years was rather anomaly. QE was not the norm. QE was there because central banks feared a disinflationary environment, deflation, and a weaker economy. Now, while changing circumstances and the unraveling of QE and rising rates is a change, and change is often not welcome, it simply signals also to us that there is a cost of money out there right now. It's called interest rate. And all those companies that are zombie companies out there that only made a living because rates were zero, kind of lost the right to exist. So a bit of sanity is coming back into the global economy. Weak companies getting pushed out, and the winners will take a greater share of the economy. Very healthy thing that always was there, and I think it's very important and the bedrock of our kind of economies in the West.